Hey everyone, it's Kim Adams at Total Wealth Consulting. Hope you're having a wonderful Monday. Happy New Year. I think a lot of you are probably still off. I know it's the holiday for New Year's Day, but I decided I'm ready to get back to the to the task of building my business and chatting with you all. So didn't want to postpone our Monday Talk Monday another week. And today, what I thought I would do, it's a great time to do all of this, soul searching and make plans for the new year. And on December 12th, the Money Talk that I did then talked about savings. And, if you're struggling to save, what might be the underlying cause of that? I would encourage you to go back and watch that Facebook Live. In summary, though, someone that has trouble saving, and I see this across the board when I'm working with my clients, someone that has little savings and really struggles to save money usually had some type of loss in their past where they lost their sense of safety and security. And so until that trauma's cleared and released, they're always going to have that issue, right? Because having money does feel safe and secure. But if you're running on a program where you didn't feel safe and secure, you're just repeating the pattern. So once you clear that, all right, so I thought I would give you a little tactical advice today. And it has to do with how to invest and encourage you to invest on a regular basis. So something that's very recommended, and I highly recommend it, did it for many, many years, and now advise my kids to do it too, is dollar cost averaging. And dollar cost averaging is investing on a regular basis. So let's say you're going to invest $100 a month into an investment, maybe a mutual fund or something like that. It's much better to just invest the same amount every month on a regular basis, whether it's weekly, monthly. I guess that wouldn't be any less often than that. Excuse me. That's much, much better than trying to just put a lump of money in the market at one time. And to illustrate this, hope this works. I just spent some time writing these so you can read them because, when you do everything on Facebook, you have to do it in reverse, okay? Before I show you this, I'm going to post this chart. I'm going to create a chart in Excel. I'll print it to PDF, and I'm going to post it in my Facebook group. I cannot post a file or upload a file to this page. But if you're not a member of my Facebook group, come on over. It's called the Total Wealth Entrepreneur. So I'll post the file there. So if you have trouble understanding or seeing what I'm doing here, you can download the file. So I try to do this to illustrate, all right, what I'm talking about. All right, so here it is. Let's see here. You can see this. Yeah, okay. So here's what we're doing. Each month, okay, here's the months. Had to add them on because I forgot them. We are investing the same amount each month. So each month for the first 5 months of the year, we're going to invest $100 a month, all right? This is the stock price for that month, all right? The average, let's say. So January, you're spending $100, stock selling for $10, and this can be actually a single off, a one-off stock, or it can be a mutual fund share, all right? Doesn't matter. You're buying $100 worth, price is 10, you get 10 shares. Cool, huh? February, the stock price goes up to $20 a share. You're still spending $100, but now you're only buying 5 shares. And this is the beauty of dollar cost averaging and why it works so well, is because when the stock price goes up, you're buying less shares at that price. When the stock price goes down, look at March. Price goes down to $5 a share. You're still paying $100, right? Investing your $100 per month. Now you're buying 20 shares at just $5. You see that? In April, the stock price goes up to 25. And I know this is erratic, but I'm doing it to explain a point. The stock price goes up to 25. You're still spending $100. but you only buy 4 shares at the $25, right? May, price is back down to 10. You invest 100, you got 10 shares. So after the first 5 months of this year, and this could be, this could be you this May, right? You invested $500 and you have 49 shares. Okay. The way most mutual funds will give you, they'll actually provide information to you at year end. They'll calculate an average cost. So to get the average cost of what you have now, you invested $500, you have 49 shares. And that comes out to $10.20 a share. That's the average cost of your shares. So do you see how the beauty of dollar cost averaging worked? All right, so in this month when the price of the stock was $5, you ended up buying 20 shares at $5. When the price goes up, you're buying less at the more expensive price. So on average, you have 49 shares and the average price is $10.20. That's your basis. That's the average cost basis is $10.20. Now let's say in June, you decide you're going to sell all those shares and the stock price is $15. Okay? So what does that give you? If you sell all 49 shares at $49, you get $735. That's your proceeds. Your cost, again, was the $500. So you have a profit of $235 before tax. All right, you with me so far? Makes sense? Okay, now, what would have happened, though, if instead of spending $100 a month, all right, like we did here, what if you had put all of your $500, what if you'd spend it all in, let's say, February? Is that right? When the price was 20. Yeah. If you had spent all $500 in February when the price was 20, you would only have 25 shares. Okay? So if you now in June sold 25 shares at $15. Remember I said the price went down to $15? If you sold all 25 shares at $15, you would have $375. Your cost was $500 and you had a loss of $125. A $235 gain in the first scenario versus a $125 loss is a difference of $360. Do you see that difference? It's huge, okay? So, I don't know if you capture that at all. Like I said, I'm going to post it as a file in my Facebook group called the Total Wealth Entrepreneur. So if you're not a member, come on over and you'll be able to download the file. But again, the idea of investing on a monthly basis, the same amount, right, in the long term is going to give you a much bigger return than just trying to time the market, just trying to lump in like $500 here and there, $5,000 here or there. It's a really big deal over the long term. I use small numbers too. But think about it. That was a $360 difference on an investment of only $500. So what if your investment had been a lot bigger than that? It would have had a huge swing. So hope that made sense to you. And again, if come over to the Facebook group, I'll download the file. You can download the file. I'm going to upload it there. So hopefully that helped you a little bit understand the benefit of regular investing and the dramatic impact and shift it can have if you just try to time the market on your own or just intermittently invest. Okay? I'm signing off for today. Hope you have a wonderful week, and I'll talk to you real soon. Bye.